What happens when the world's biggest oil producer faces an escalating wall of sanctions? Russia's energy sector is critical, funding over 40% of the Kremlin's budget before the 2022 invasion. For years, they've relied on a shadowy armada of tankers to circumvent Western restrictions. But a new round of sanctions in October 2025 just rocked global markets, sending Brent crude futures soaring by over 5% to exceed $65 per barrel. Today, we break down the effectiveness of these financial weapons in just 5 key points, using the latest market intelligence. Point 1: The Sanctions Paradox: Resilience meets price pressure. Despite logistical challenges and a recent escalation targeting the shadow fleet, Russia has remained remarkably resilient, sustaining its crude exports. In fact, Russian crude exports reached a new seasonal high of 3.7 million barrels per day, (MBD), in September 2025. This resilience is partly due to Ukrainian drone strikes taking Russian refining capacity offline, forcing more crude onto the export market. However, the core tool designed to hurt Russia, the oil price cap, was recently lowered to $47.60 per barrel. The price cap's goal is dual: drive down Russian export revenue while simultaneously preserving the volume of oil traded globally to keep prices stable. This reduction should, in theory, create challenges for Russia in securing adequate tanker capacity. Point 2: The effectiveness gap: Why U.S. sanctions hit harder. Not all sanctions are created equal. Our analysis shows a huge difference in the impact of restrictions depending on the issuing body. U.S. OFAC sanctions are assessed as far more effective, causing an average productivity decline of 70% in the vessels they target. In sharp contrast, vessels sanctioned exclusively by the EU or UK see a reduction estimated at only 30%. Why the massive disparity? Experts suggest that Russia's trading partners are far more hesitant to challenge U.S. institutions, reflecting their significant exposure to the U.S. dollar for trade and financing. Even though the EU and UK account for the majority of vessels currently sanctioned, OFAC's leverage is demonstrably stronger. Point 3: The global trade split: China versus India. The destinations for Russia's sanctioned oil depend heavily on who imposed the restrictions. 1. OFAC-sanctioned vessels. These ships primarily move crude from Russia's eastern ports to China. Eastern hubs like Sakhalin and Kazmino dominate the loading activity, with Chinese ports ranking as the top destinations. 2. EU/UK sanctioned vessels. These ships primarily serve India. In the third quarter of 2025, India actually overtook China as the top destination for cargoes carried on these EU/UK sanctioned tankers. For India, the share of crude imports transported on these vessels rises to 18%, compared to just 0.5% on OFAC-sanctioned vessels. This reveals a clear split in how the shadow fleet operates across Russia's major Asian buyers. Point 4: The October shockwave, targeting Rosneft and Lukoil. On October 22, 2025, the U.S. Treasury took a massive step, imposing sanctions on Russia's two largest oil companies, open joint stock company Rosneft Oil Company, Rosneft, and Lukoil OAO, Lukoil, for operating in the Russian energy sector. The UK had already sanctioned both firms on October 15. This escalation immediately sent shockwaves through the market. Brent crude futures jumped by over $2 per barrel and exceeded $65 per barrel on October 23. These U.S. sanctions mean that all property and interests in property of Rosneft and Lukoil, and subsidiaries, that are in the U.S. or controlled by U.S. persons are now blocked. Point 5: Buyer recalibration and the secondary sanctions threat. The new restrictions immediately prompted crucial buyers to act. 1. Indian reaction: Indian refiners are reviewing their trade documents. Crucially, Reliance Industries, India's largest buyer of Russian crude, plans to recalibrate and sharply reduce its imports of Russian oil to align with government guidelines and avoid running afoul of the new Western sanctions. Analysts suggest that if New Delhi cuts purchases under U.S. pressure, Asian demand could reverse toward U.S. crude, leading to higher prices in the Atlantic basin. 2. Chinese reaction. The Chinese refining market, which relies on Russia for up to 20% of its crude imports, about 2 mbd, has also deeply felt the shockwave. Ultimately, for the price cap to maximize pressure on Moscow, policy experts suggest the most effective action would be for the U.S. to impose secondary sanctions. This involves threatening sanctions against any market participant, be it Chinese or Indian firms, shipping companies, insurers, port operators, or banks involved in transactions above the price cap. This threat reinforces all three methods of revenue suppression: strict enforcement, increased risk premium, and enhanced buyer negotiating power. Conclusion and call to action. While Russia has sustained volumes, the latest coordinated action targeting Rosneft and Lukoil is forcing a major realignment among key Asian buyers. The future effectiveness of these sanctions hinges on whether Western coalitions, particularly the U.S., have the political will to implement broad, continuous enforcement, potentially including the powerful leverage of secondary sanctions. Let us know in the comments, do you think these new sanctions will finally cut into Russia's oil revenue? Don't forget to like and subscribe for more expert-driven market insights.